They come the first rates then this Thursday morning, and seems like a quiet start indeed it is, though we are holding on to that 17,500 price level, so that indeed is the key takeaway. Let's see what HDFC Bank are doing, what Bajaj Finance and L&T are doing, the big movers from yesterday. HDFC Bank a little bit tempered, a little bit soft for HDFC as well. Bajaj Finance will just come off on your screens next, and then of course L&T, FinServ down a little bit. 0.6% lower for Bajaj Finance. So no, yesterday's rally is not really continuing. L&T though, mildly up in the green at 22.65 levels. So latching on to yesterday's gains in that sense. The other movers yesterday were also ITC and Sun Pharma. They held that very smartly. So did TCS. And then, of course, it was the mid-cap IT and the gas names from within the broader end of the market, which did make a very, very good move. Sun Pharma flattish, IGL, MGL. Let's see what those stocks as well are up to. TCS mildly soft. IGL still going up, 1.25% higher. The cabinet as well is going to be meeting today. And perhaps you will see a final outcome on gas. So in anticipation of that, some of these stocks are still holding out. What about Coforge and LTTS? They were the high flyers from yesterday within the mid-cap IT pack. So just look out for that as well. And then, of course, a slew of other, updates as well. Nykaa, Avenue Supermarts, they all came out with their Q4 updates. So let's see how the street is reacting to that. Nykaa is currently lower by about 1.5% along expected lines, given that the fashion business saw impact from less consumer spends in the fourth quarter. And of course, this heightened competition now from Reliance Retail Steera as well. 1.5% lower for FSN e-commerce or Nykaa as we speak right now. Chola Finance also came out with its Q4 update, and impressive when it comes to the disbursement figures, both on a sequential as well as a year-on-year basis. So that's another stock in focus, and the new dispersals have risen nearly about 86% actually on a year-on-year basis. Chola Investment holding up 4.6% as we speak right now. Angel One also came out with its numbers, the Q4 update that is, and the client base has come in higher, 3.3% on a month-on-month basis, and the number of orders is pretty steady. A growth trajectory is what it's indicating. So that's another stock which is in focus. Equitas as well, the deposits have come in higher by nearly about 34%. Tata Steel, the Q4 production volume has come in higher by 5.1%. So look out for that. And IEX as well, wherein the March total volumes are actually down 4%. And I'm only bringing up IEX because this has really been a trading favorite of late. And the stock as well has been holding out very well. But yeah, the Q4 update is not looking all that strong. The prices are down 23% on a month-on-month basis. So that's IEX in trade for you. Aman, what are you spotting?
Well, within the broader markets as well, it's pretty much a listless day of trade, although you have it pretty much neck to neck with the frontliners. Although, as I said, the breadth is in favor of the gaining side. There's a bunch of losers here. So just checking in on names like Vedanta, for instance, Aditya Birla Fashion, Minda Corp, Rail Vikas Nigam, which was active yesterday, KPIT Tech, as well as Cochin Shipyard. Those are some of the big losers. Chola Investment, as well as Ujjivan Small Finance, KC, those are some of the buzzers. Let's get in those first trades then. What is it that our charters have punched in this Thursday morning? And Kunal, what's looking good given the fact that otherwise it's a pretty dull day of trade, at least for now?
So yeah, I think we expected this kind of a very muted kind of a tick on the indices, so it doesn't go as a surprise, frankly, Avan. In terms of individual stocks, the stock which I would be looking to recommend to clients would be on Bajaj Auto. Specifically, the stock has given a classical breakout on the short-term charts as well as on the medium-term time frame charts, trading now just close to that 4,000 plus mark. So that's a stock which I'd be bullish on, would recommend to clients as well.
Nooresh, your top trade?
So continuing to add positions on Indian hotels, waiting to add more above 330 levels. So that's a buy at current levels.
Let's also welcome on board then Pankaj Tibrewal and find out what he's making of the current market construct. Pankaj, hi, morning. Good to have you on the show. Yes, important event today, the RBI MPC outcome. But that said, a lot of pain seems to be behind us, and the market prices as well are reflecting that. The fact that FIIs have turned buyers consistently for the last 4 trading sessions. Yes, crude is again volatile, But looking at the price action, the fact that we're back at 17,500, 600 now actually on the futures, doesn't seem like it's bad going at all.
Good morning. Absolutely. If you have been hearing us, we have been cautious on the markets for the last almost 10 to 12 months. And we believe that now market peaked at about during the month of September 2021. It's almost 18 months that markets have given no returns. And if you adjust for the earnings growth during this period, which was about 16 to 17%, and on dollar terms, markets have actually corrected by on a relative basis 16 to 20%. So I think next 6 months will be a very exciting time. We believe that from here on, valuations have started to look a lot more reasonable. A lot of froth from the broader market is out, and the next 6 months will give us great opportunity to start increasing the equity allocation. Uh, Always remember there are certain milestones if you go into the history, which we have been watching out before actually market bottoms out. History suggests that there always is one credit event. We saw that happening last month where four banks, three in US, one in Europe, actually going down. And that was an important one. The second milestone we normally track is that markets don't bottom out before earnings downgrade cycle of 10 to 15%. In Nifty, this time we have seen about 5 to 6% earnings downgrade already. Our sense is that next 2-3 quarters, probably markets would, built in estimates which will be lower than where the current estimates is for the broader market earnings as well as Nifty earnings. And the third point is that normally we have seen market cap to GDP bottoming at about 65, 70 or 75%. And today we are at 90%. So I think in the next 6 months, looking at the uncertainty, and if we reach these milestones, markets would give us great opportunity to increase our equity allocation. So our tone of cautiousness has started to reduce. And we believe that next 6 months should be used as an opportunity to increase your equity allocation and expect returns in 2024 and 25.
Right. So, Pankaj, you've always been known for, spotting stocks, spotting sectors that have corrected a lot. They are in neglected zone, and within then, probably you choose the first two leaders. So approach continues to be the same. Stick with companies that have larger market share in the sector and which sectors have been neglected. Is that the approach that you continue to follow?
Absolutely. I think next 6 to 8 months will be a great time from a bottom-up stock picking, because the contours of broader macro construct is very strong. And I believe that many companies from here on over the next 5 to 10 years will become very big in size, provided we pick up the companies carefully. And my sense is that manufacturing is one area where we've been positive on. And we believe that it's a multi-year growth story. And kind of changes we are seeing at the ground level makes us believe that many of the winners of the next cycle will be from this space. Also, financials continue to do well. Selected NBFCs and private sector banks where we are positive on. The third sector where we are incrementally evaluating, and almost 4 to 5 years of price as well as time correction has happened, and valuations have started to turn attractive, is pharma. And we believe that there are many good quality companies with strong balance sheets and cash flows there. And selectively, we are evaluating pharma as a incremental investment space. Also on a cement, we believe that incrementally things have started to turn positive. The cost pressures have started to ease, and the outlook on profitability has started to improve. And this is one sector where going into the next couple of quarters, we could see earnings actually being revised upwards rather than downwards. So I think these are the 4-5 places where we are trying to hunt for the best of the companies and from a bottom-up stock picking approach.
Right. Pankaj, I was wondering, you would put, last time around you were very bullish on banks, NBFC. I mean, last time means in the previous cycle. And of course, NBFCs did quite well till the IL&FS issue happened. This time around, your view on NBFCs, you believe that NBFCs can do well? Some of the names are really beaten down.
I think in this space, what has happened is that distinction has happened between good and bad. And clearly the consolidation has happened in this space. And there are very high quality NBFCs of maybe around 4 or 5 of them, and some of them are part of our portfolio also. So we believe that yes, the consolidation has played out quite well. The strong players are now existing, and they will continue to grow over the next 3-5 years. And there are some monoline businesses in this sector. So, for example, vehicle financing, rural financing, uh, commercial vehicle financing. All these, if you want to play, some of the NBFCs are in a very good spot, and valuations have also corrected. So I think it's a great time because the interest rate cycle is looking to peak out in the next 3 to 6 months, and some of these wholesale funded NBFCs will be beneficiary once you start the interest rate cycle coming down.
Okay, fair enough. Pankaj, hi, morning. Let's also get in your take as to what the outlook is when it comes to the entire pharmaceutical space, because the theory or the thesis is rather that you're being very selective here. So what exactly is it that you're looking for in the companies that you invest in?
So in the pharma sector, what we have seen for the last 3-5 years is that US has been a spoiled sport. You have seen consolidation on the buyer side in US, and that has led to pricing pressure for most of the companies in the US market. Uh, what we are incrementally looking at is that the Indian business continues to do extremely well. And there are many companies which have very strong franchise in India. And it's like an FMCG, quasi FMCG business where cash flows are strong, return on equity in the Indian business is extremely strong, and they generate quite a bit of profits from the Indian business. So that's one part where we are extremely positive on companies which have a dominant share in the Indian market. The second one is that in many companies, what we are seeing that along with Indian business, they have the US business. And if you do the valuations today, the the valuations are only pricing valuations for the Indian business, and US business is either coming free or maybe slight negative in some cases. And there we are seeing that as incrementally we are seeing data points, the price erosion has started to come down. Earlier, we were seeing high single digit of price erosion, and that's now settling at 4 to 5%, which is quite okay. So the incremental change in the US is actually turning out to be positive. And because of last 3-5 years not being so good, many small and marginal players are vacating that space, which will be very, very positive for serious players out there. And the pricing will, kind of consolidate. So I think that's where we are looking at that. Which are the companies where you think that incrementally things are changing better in US, and from a valuation perspective, market is not subscribing any value to the US business now, and it's not there in the price. And hence, we believe that this will be the way we are approaching the pharma sector. The second approach is also to look at for the pipeline of many of the US generic companies. And some of them have very strong pipeline for the next 3-5 years. And we have started to look at the value which can be from a medium term perspective. And hence we see that there are some opportunities from a bottom up basis on the pharma sector as well.
In terms of FMCG, do you see a similar sort of a move? I mean, they have of course not beaten down names, but for years they have not done anything. Like 3-4 years, HUL price and Nestle price is probably similar to what it was 4-5 years back, and earnings of course have grown marginally.
Absolutely. So incrementally, in some of the consumer names, we are turning constructive. We believe that 2020, a large number of names in the FMCG sector peaked out. And from there, we have seen a very subdued performance, courtesy, subdued earnings growth. Incrementally, what we look at, there are 2-3 data points. One, I think the gross margin pressures, which were led by the raw material index, has started to turn positive for most of these companies. And over the next 3-4 quarters, we should see incrementally gross margin actually improving for most of the FMCG companies. The second one is that rural has started to show some signs of revival. And don't forget that next year, May, we have the election. And if you go into the history, 6 to 8 months before election and 6 to 12 months after the election, this is one sector which generally does well, because money gets spent at the lower of the pyramid on the rural areas, and that actually translates into consumption for most of these companies and good revenue growth. So we believe that FMCG sector selectively can be looked upon. And recent updates which we saw from a couple of companies were quite encouraging, which came over the last couple of days. And we believe that from here on, the worst is priced in, and incrementally we should see better revenue momentum and better gross margin momentum going into the next year.
Right. Pankaj, the other space that I wanted to talk about with you is also cap goods. You know, I mean, as large an umbrella as it may be, would you say that stick to the more top-up stories, more the L&Ts, or would you say that, you know, this is pretty much a broad-based call that you have on the sector, and, you know, just about any pocket is going to be lucrative even at the current levels?
So we believe that India is going through a major transformation on the industrial side and manufacturing side. And that makes us believe that it will be a broad-based recovery. And many of the cap good names, including the large ones, will be clear beneficiaries of that. And we are seeing it that for last 18 months as well. In between, there may be some volatility because of the order inflows and stuff like that. But structurally, I believe that private sector capex has started to fire, which was not the case for almost a decade. For a very long period of time, we were stuck between that 5 to 6 lakh crores of private sector capex annually. If you look at from a trailing 12 months perspective, we have already crossed 7 lakh crores. So I think that's a very encouraging sign. And if you look at some of the annual reports of some of the MNCs, which have been released over the last couple of months because they are calendar year ending, they clearly mention that we are shifting a part of our plants from Europe to India, and India will become the manufacturing hub for the rest of the world. I think if many of these corporates follow this policy, it's not only the import substitution, but also the export opportunity which will be knocking at our doors. And I think these are some of the themes where the broader economy will participate. Many of the cap good names, whether it be serving to energy sector or the green hydrogen or the incremental consumables, will be beneficiaries out of that. And we continue to remain positive on the broad overall capex recovery theme. And capital goods is, I think, a great proxy to play that revival.
It is, Pankaj. So great to have you on the show. Thanks, as always, for taking the time out.
Thank you so much.
Okay, let's move on. Let's talk about what the GMR Group has been up to, what their growth plans are post the recent restructuring, and of course, what do they have to say about the deleveraging? What about the debt on their balance sheet? Let's take stock of all of that. We have Saurabh Chawla joining in from the GMR Group on the show. Saurabh, hi, good morning. After the last few years of restructuring, the structure is quite leaner and more efficient now, as we understand. What's the focus area for the management, and how is it that you see the next 3 to 5 years shape up for the GMR Group?
Well, I think the major part of the restructuring is over. We had demerged the airport business from the non-airport businesses more than a year back. And what we see right now is the last leg of that process. So merging of the private airport platform, in which Group ADP is a 49%, merging that with the listco is the last leg of that process. So the path that we had embarked about 5 years back was primarily to delever our balance sheet and to make our businesses pure plays. Those were the offerings that we wanted to take to the capital markets. We have significantly delevered our balance sheet, and now, as I said, with the merger of this private airport platform into the listco, this will be the last leg of that exercise. On the GMR energy side and the road side of the business, which is the demerged businesses, work is still yet to be done, but that's a separate conversation we can have sometime in the future.
Okay, so let's take things then one by one, because you talked about deleveraging. Give us some more details. What's the current debt, post the fund flow in FY24, and what would be the sustainable debt level you think, say, by March 24?
So honestly, I'll tell you the numbers which were as on December 31st in the listco, the consolidated numbers in the listco, which is the GMR Airports Infrastructure Limited, the gross debt was about 299 billion rupees. And we had cash and cash equivalents of about 49 billion rupees. So my net debt on the books was about 250 billion rupees. That was the status of debt at the listco in a consolidated form. Having said that, 19% of 7% of this debt, which is about 19 billion rupees, was the corporate debt. So our strategy was that at the holdco, where you do not have stable cash flows, we wanted to pare down that debt itself. And this issuance of foreign currency convertible bonds will ensure that this debt is also settled once for all. So this 7% debt of 19 billion rupees, that will get fully settled at the corporate level. The second aspect is, which is important, is that with this reverse merger of the airport platform with the listco, the operating assets come closer to the shareholders. So usually you have at least 15 to 20% holdco discount that happens from the operating entity levels into the holdco. And here, because it will be merged, the airport platform will be merged with the listco. That discount will pare away over a period of time. The cash flow efficiency of the upstreaming of cash flows as and when the free cash starts to happen, that will drive value for the shareholders. It will drive dividend flows to the shareholders as we go forward. So this is a very important aspect that we need to keep in mind. At the airport operating levels, because these are operating assets, the debt over there is taken care by the operating cash flows that come in those assets, and they're quite fine as we speak forward, because most of the capex now is completed and traffic is coming back with a bang. So that's all. That's the way forward.
Good morning, sir. You said that bulk of the capex is now over. So are you going to slow down on the expansion now? What is the capex and expansion plan from here on?
So we're always looking for opportunities, but I think it's a parallel exercise. Our main focus is to strengthen our balance sheet, and this corporate debt deleveraging is a major exercise in that direction. As we speak right now, the capex plan for Hyderabad is almost over. The expansion to more than 30 million passengers has been completed. And as traffic continues to grow in that part of the country, you will see much better metrics emerging from Hyderabad. And very interestingly, you see Hyderabad has got revenue share of just 4%, and hence we expect actually dividend flows to start happening in fiscal year by end of fiscal year 24 or fiscal year 25. That's our expectation as far as Hyderabad is concerned. Delhi also, we are in its last leg of its completion of our capex. The capacity for Delhi airport is being taken up from 55 odd million passengers to about 100 million passengers. This is the last large capex that is being undertaken at Delhi airport, with 4 different runways and cross taxiway to improve the efficiency of aircraft movements. So once this is completed, which is expected by September, October of this current calendar year, we are on our way to scale up these businesses. Just to also highlight that today the traffic run rate is above the pre-COVID levels. So at the pre-COVID levels, we are doing more than 60 odd million passengers in Delhi airport itself. So if I'm talking about it's above the run rate of 2019, then we are expecting that this number should, we are upwards to about 70 odd million, and we are talking 100 million capacity already in place. So it's a good point to be in, where we expect free cash to emerge in a defined period of time. Major capexes are over with. Refinancings are happening today at lower than the interest cost that we have on the books. So I would say it's good steadings as we go forward.
Let's take it a bit more pointed. Government is pushing a lot of new airports. Will GMR bid for it? Anything in the pipeline?
So first of all, let me clarify over here. It's not restructuring. In India, the word restructuring has a bad connotation because you go to lenders and you tell them that I don't have money to pay you, so restructure debt. This is a path forward to make our corporate structure leaner and meaner and make it far more efficient. So a merger of a private entity, a platform entity into Listco is not restructuring as such. It is to make the whole corporate holding structure far more efficient. To answer your question, are we looking for new airports? Yes, we are looking for new airports. In India itself, we have today two large airports which are under operation. Mopa has opened up. It's doing more than 10,000 passengers per day. It's already exceeding our expectations of traffic. And right now, international traffic has not yet begun at Mopa. We are going to begin a development of a new airport in Bhogapuram, which is Visakhapatnam. That is going to start sometime during this calendar year itself. We are in the process of completing the project financing for that particular airport, and we have a small airport in Bidar. So there is enough on our table right now, but yet we will always be looking at opportunities to see how we can get into more airports within the country. It is the fastest growing aviation market in the world. It's a large market. And as India's economic growth gathers steam, as per capita income goes above $2,500, there will be an increasingly movement and shift from rail travel to air travel. And we want to capture that opportunity for sure.
Now, Mr. Chawla, the Kotak report that's come out has compared GMR airports to the airports of Thailand, making a case that it's valued as a perpetual business. So what's your take on the business valuation going forward?
No, I think Kotak has spoken. It has given various benchmarks, and I really don't want to, comment on that. It's a third-party independent report as such. But the underlying theme is correct. If you look at EV EBITDA multiples, we are probably the cheapest airport available on a platform level in India. And India is a far bigger market than Thailand is. And again, like I pointed out to you, we are at that inflection point where most of our investments within India are completed, especially in the two large airports of Delhi and Hyderabad. So we are very, very uniquely positioned to give shareholder value as we go forward. So far, GMR Infra has been valued as a conglomerate. We have created a pure play, and now we have merged these two entities to create a first pure play listed entity where the operating assets are very close to the shareholders, and hence, the expansion of the multiple is a given. So let's wait and see. I think that's our focus, and that's what I think some of the analysts on the streets are also recognizing, and I think the recent uptick in the stock price is also reflecting that.
So what is the timeline of the fund flow from Group ADP, and how exactly is the money going to be used?
So the money of the FCCB, 2,900 crores has already come in, and it came in before 31st of March. And about 100 crores of the 550 crore earnout, that has also come in. So the total inflow of cash from Group ADP of 3,000 crores has already come in. And in effect, actually, we are not only net debt zero, but at the corporate level, but there are surpluses which are there. So that action plan has already happened. As we go forward, I think, as I said to you earlier.
Right. So any further monetization plans at perhaps the asset level of the holdco company?
No, we are not looking for any monetization. We are only looking at improving our profitability and cash flows. At the airport level itself, at the asset level itself, we had already stated some time back that we could look at partnership at the asset level with some of the financial majors. And with respect to that, if you look at in Goa, we had signed an agreement with the Indian Sovereign Fund NIF. So we are open to at the asset level. We are not looking at monetizing any shareholding either at the asset level, operating asset level, or at the holdco level. Not at this stage.
Right. Thank you so much then for taking the time out and speaking with us, Saurabh. Good to have you on the show. Okay, on that note, we're going to take a very quick break. What is the status on the markets? We're absolutely quiet ahead of the policy announcement, 17,585, down just a smidge on the index. And let's bring up the Nifty Bank as well and show you how that is panning out, because that also is looking relatively quiet. We'll take a very quick break. When we come back, full tilt on what to expect from the MPC.
Welcome back. Well, the market is going a bit tempered into the RBI monetary policy meeting because the Nifty is down about 30 points. Sensex also holding up in the red as well, 100 points lower. What's actually down in the trading session today are a few banking names as well, plus a whole host of sectors which are actually on the back foot. We're not seeing much reaction even for the quarterly updates, etc. that we have seen, and the Bank Nifty clearly is underperforming today. So that's one space that we're watching out for, below the mark of around 40,900 thereabouts. But as we are all counting down to the MPC meeting and we'll get the outcome in less than 10 minutes from here on, let's try and understand what exactly is the street penciling in at this point of time. Ankur, my colleague, is here with the expectations.
In a few minutes from now, Reserve Bank of India Governor Shaktikanta Das will detail the monetary policy, and the expectations are that there will be a hike of 25 basis points in the repo rate. There is also an expectation that this might be the terminal rate after 25 basis point hike. Now we need to wait and see whether or not there is some signal from RBI governor on the same. Apart from that, liquidity is something which banks are watching out. The indication is that the system liquidity is around 1 lakh crore. So we need to wait and see what steps the Reserve Bank of India takes for maintaining that surplus liquidity, because time and again it has been told by Reserve Bank of India that the liquidity will be maintained and there will be sufficient liquidity in the system. Apart from that, inflation forecast is something which all eyes will be there, because last time there was a revision of 6.5% forecast for FY 2023. Now we need to wait and see whether or not there is a tinkering of forecast, because last 2 months the CPI has remained higher and it is beyond the comfortable range of Reserve Bank of India, that is 6%. Also we need to wait and see what are the announcements which are outside monetary policy, which are made by Shaktikanta Das in the press conference which is set to begin soon.
Yes, just a few minutes and all that suspense is going to be broken away. Let me welcome on board then consulting editor ET Now, Maithili Bhusnarmath as well. Maithili, hi, morning. Seems like a 25 bips hike is pretty much on the cards and factored in. I think it's more the shift in policy stance, whether it's going to move from neutral to signal any sort of, end to the current tightening cycle or not.
Well, yes, the markets are certainly factoring in a 25 basis point hike, though strictly speaking, there is a case, a very strong case for a pause, as 2 of the 3 external members have already pointed out. Simply because at this stage, a 25 basis point hike serves no purpose. Monetary policy acts with a very long lag of about 3 to 4 quarters, and you can't make up for time that you've lost by going in for higher for longer. So the entire focus on inflation at this particular juncture, given the trade-offs, is, I think, a little misplaced, particularly because financial stability has entered as a new consideration. Of course, in India, financial stability as of now is not an issue, primarily because our reliance is on retail deposits. The bulk of the banking sector is owned by government. So none of the issues that really plague the banks in the US apply over here. Even so, I would think there is a case for a pause, as Jayant Pharma and both Dr. Goyal has also pointed out. But I think the Reserve Bank will opt to play safe simply because they can't afford to take any more flack. So I think they will hike 25 basis points. As far as it stands, it's really not very important, because even the rates don't have carry much weight in terms of signaling. So stance is really, just semantics, I would say. But maybe they would move from withdrawal of accommodation to something a little bit more dovish.
But given the fact there has been a pivot when it comes to the macro landscape across the world as well, do you think it increases the chance of any rate cuts happening this year itself, or that's not what we're talking about at this point of time? It's only probable in calendar year 24.
Yeah, well, I think rate cuts are completely off the calendar. There is absolutely no case given how high inflation is. So at best, you can hope for a pause, particularly because in India, unlike in the West, we've had high inflation for much, much longer. Now, close to 3 years, RBI has already had to write one letter to the government, and the time may soon come up for them to write another letter saying why have they failed to stay within that band. So I don't think there's any question of a cut at all in the near future.
Okay, but what about the expectations with respect to growth and inflation? Are you expecting some sort of tinkering there as well?
Oh, well, growth, we've already seen the World Bank has lowered India's forecast for this fiscal. We'll have to see what the RBI's own view on that is, because the fact is that the world economy is slowing down. We've seen signs of recovery in China, but all over the West, there are signs very clearly of the slowdown happening. The US is still doing reasonably well. The labor market is quite hot, but the impact of the rate hikes, which have been much more dramatic and in much shorter a period, is bound to be felt. Add to that the new political uncertainty introduced in the US, financial instability. So I think the world is going in for tough times, particularly as far as trade is concerned. And exports have been a major driver of growth for us. So that will be missing this year.
We were just chatting with Upasna Chhachra from Morgan Stanley, and she actually believes that if there is a 25 bips hike this time, which is pretty much well on the cards according to her, this could very well be the last rate hike of the current cycle. Let's hear out her views.
We are also expecting a 25 basis points rate hike tomorrow. We think that should be the last rate hike in this cycle. So we're looking at a terminal repo rate at 6.75%. I think the upside in the inflation numbers that we got in Jan and Feb sort of cemented the case for another rate hike, but this should be, marking the end of the rate hike cycle in our view. The key to, I think, watch out for in tomorrow's meeting would be on the stance. So we are not expecting a change in stance. We think that the external factors, the uncertainty around them has increased especially in the last month. So we think that RBI or the MPC will likely not change the stance tomorrow. But I think that's one key thing to watch out for in terms of how or if any there's any change in the wordings of the stance from the RBI. And secondly, I think liquidity is also on top of everyone's mind. So anything on that front that RBI indicates, again, we are not expecting too much coming out on the liquidity front as well tomorrow, given that we think that RBI will do a rate hike and also not change stance. So in that context, it will be sort of inconsistent to come up with any other measures in view of the liquidity issues that are on top of it.
Okay, so that's the take coming in from Upasna. Less than 3 minutes for the rate decision to be out. But Maithili, is there anything else that you'd be watching out for in terms of commentary, in terms of any other liquidity tightening measure, etc.?
Well, I think we will hear the governor talk once again about how low rates on government securities are a public good, because just recently the RBI cancelled the entire auction on T-bills because the market was demanding higher and the RBI was not willing to concede that. So I think we will hear some talk about how it is a public good, forgetting completely that banks are actually commercial entities and they're not in the business of doing public good in that sense. That is one. So we might hear some talk on that. We might hear some talk also on the developmental aspect and also on the fact that there's no need to worry about financial stability of banks, which I entirely buy. In the Indian context, there is no case really to worry about financial stability of banks. So I think we will hear some reassuring comment on that score. I'd like to see what else they have by way of developmental aspects and whether at all they talk about CBDCs, because there's a great deal of rethinking all over the world about the need for CBDCs and whether there is a need to even proceed even slowly, even though RBI has said we'll proceed very slowly. Many central banks are having a rethink on whether there is a case at all for CBDCs at this juncture. So let's see what he says on those fronts.
Actually, if indeed it is a pause this time, how do you think then that the RBI is going to tackle inflation? Because, I was just looking at the Jan-Feb CPI numbers. They're still at 6.4, 6.5% and all the core measures are still pretty much sticky above the 6% mark.
Well, the tragedy in the Indian context is since a bulk of the consumption basket is really outside the RBI's purview, which is why the RBI needs to act much more quickly and much more firmly when inflation starts rearing its head. Because as we've seen, food and fuel constitute well over 50% of the consumption basket. So RBI's play for monetary policy is barely about 40 to 50%. Given that the RBI does not have the luxury of the Western central banks to wait, unfortunately, the RBI preferred to think, following the Fed, that inflation was transient, was temporary, so they were late to react. So, which is why at this particular juncture, even if they were to do that 25 basis point hike, it would not change the inflation picture very much. Because if we have inflation, a high inflation in India this year, it would be driven primarily by food, as we're seeing uncertain weather patterns. We're seeing, rains in the north just when the wheat harvest should have been harvested, the wheat crop is ready. So I think it's good food and possibly fuel. We don't know what's happening to fuel. We've seen fuel prices inch up. So those are the dangers really. Monetary policy has really not very much say. Hence the reason for RBI to wake up early, which unfortunately they did not. And today we are paying a price for that.
For now, the market is going a bit weak into the RBI decision. So the Nifty is down 30 points. Take a look at the Bank Nifty as well. That's holding around the level of 40,900 thereabouts. So that's something we're watching out for. The 10-year yield hasn't been doing much of late. It's just below the 7.3% mark. Let's see how it really trends post the decision is out. It's currently around 7.28, and rupee 2 has been strengthening of late. It's below the mark of 82. So we'll keep an eye out on all of these as well, and as to how they track once the decision is out, because the consensus is it's going to be a 25 basis point hike. There could be a bit of a shift as far as the stance is concerned from withdrawal of accommodation to neutral.